Hi, I'm Justin Zaks, Vice President of Strategy at Mumu Technologies. Welcome back. If you missed our first webinar, How Does a Professional Fund Manager Build Portfolio, where we talked to 3 seasoned portfolio managers, replay will be available in the app shortly. I'd like to welcome you to the second day of our inaugural 3-day event entitled Navigate Market Volatility with a Resilient Portfolio. Each day, we're going to be airing 3 webinars, approximately 40 minutes in length, with a 10-minute break in between each one. Saturday's webinars tomorrow will start at 10 a.m. Eastern, and Thursdays are already available for replay in the live section of the Mumu community in the app. The event, which will give viewers an exclusive opportunity to learn about a variety of topics, including zero DTE options, ETFs, portfolio building, earnings season, U.S. elections, and how to use the Mumu app, along with many, many more. We're going to be talking to a number of experts from SIBO, Wellington Management, BMY, Franklin Templeton, as well as a number of other leading financial professionals. Our second webinar of the day, Earnings Season Analysis and Truth About Growth versus Value Stocks, features Chris Galipeau, Senior Equity Market Strategist at the Franklin Templeton Institute. If you're interested in how the earnings seasons turned out so poor and what that might mean for your portfolio, please stay tuned. Chris is going to break down which stocks and sectors have done well and which ones haven't. He'll explore the companies, the outlook for the future, and examine the difference between growth and value stocks and which ones might be right for you. Please enter your questions for Chris in the chat right now and make sure to watch the entire webinar. We'll try to get to as many questions as we can in the 40 minutes allotted. If you do enjoy the webinar, please check out the live section of the app under the Discover Mu tab to sign up and set a reminder for more of our informative upcoming webinars. Let's dive right in. Welcome, Chris.
Justin, thanks for having me.
Thanks for being here. Why don't you tell our viewers a little bit about yourself and what you do at Franklin Templeton?
Yeah, sure. So this is my 33rd year in the investment business. I've spent all that as an equity analyst, as an equity portfolio manager, as a growth portfolio manager for a long time. And for the last 10 years, I've moved into the strategist role. And I guess I'd say my day-to-day function is really trying to provide input, insight, guidance to our clients around the world with regard to equities. And that can take a lot of different shapes and a lot of different forms. It can be dependent on macro inputs. It can be dependent on sector sort of information. It can be right down to the micro level, although we tend to try to avoid that as much as I can. But it's really just an effort for Franklin Templeton Strategy Desk to interface with our clients, share our opinions, share what we think is important on the future direction of either the economy, the stock market, or both.
Great. So why don't we get right into the earnings season and what's happened so far? We're pretty well far through the the third quarter earnings season. What have the results been so far, and what has surprised you the most this season?
All right, so Q3 earnings are done. Well, actually, there's still maybe 18 or so, 20 companies that are left to report, but they're not that significant. What we've seen so far throughout Q3 is pretty much in line with what we've seen year to date. So in Q3, revenue growth was plus about 5%, and I'm referring to the S&P components, and earnings growth was up about 7%. That's more or less, in line with what we've seen here through Q1, Q2, and now into Q3.
And what type of stocks or sectors have outperformed or underperformed this season?
So it's been a pretty consistent theme all year. I'd say on balance, so if we start at the index level, the S&P's up 23% year to date. We'll pull back here this week. The lead sector for the year, or the lead sectors, are as follows. So the financials are up about 32%. Communication is a broad sector. Some of the tech stocks in there are about 32% tied. Tech, broadly defined, again, 32% broadly defined. So those have been the lead horses, the real laggards in terms of performance and earnings for the most part. Real estate, energy, and materials that tend to be late cycle sectors have pretty much been the laggards here right along all year. And that probably won't change that much is our guess as we move through 2025.
And what have you noticed about any trends around the fourth quarter and 2025 outlooks from the companies overall? Is there a general sense you're getting when you're listening to the executive comments on the earnings conference calls?
Yeah, I think it's very mixed, but this might sound a little bit funny. It's mixed, but it's been very consistent. Meaning, what we've seen here, and this is true for really the last couple of years, is the dominant force, or the companies producing most of the earnings growth, revenue growth, and earnings growth, have come from the tech names. The audience will know those as Mag 7, but it's more than that. They've been the real predominant driver of earnings growth. And then from there, it's been a little bit mixed. Financials has been another sector that's been very strong. But when you drop down and you think about other sectors that are sensitive to the economy, think retailers, think the industrial complex, which would cover everything from, let's say, autos to the equipment companies that supply autos and any other branch of an industrial company. That's been pretty mixed, and we heard, for instance, last week, Home Depot reported earnings. And for the last couple of quarters, they've talked about the consumer being a little more cautious and delaying spending on big projects. This quarter, actually in Q3, it was a little bit better, but the consumer avoiding the big ticket items. And I think a lot of that, according to HD's management, is driven by just higher rates. So if you wanted to renovate your home, for example, and you want to finance that, well, you're going to do it at 7% versus a couple of years ago where you would have done it at 2, 3, 4, 5 in that range. But I'd say it's been very consistent with tech. Has been very strong. The outlooks and the forward looks are pretty good. Any company that's sensitive to the economy, I think they've been cautious here all year. They're giving us reasonably cautious guidance into 2025, at least at this point.
Yeah, that's a really great point. And maybe I have a little bit of a follow-up on you mentioned Home Depot that's in this real estate sector. And a lot of times people are going to be borrowing money to do these big renovations. You might see the same type of thing in autos where people take out auto loans. What about other consumer discretionary areas where people might not borrow? Do the rates still matter there? Are you seeing some difference, or is it similar? What's your thoughts on that?
Yeah, so if you think about Walmart, Target, you pick any other retailer, they're not borrowing money to finance purchases that they might be using credit cards, which is a whole nother animal too, right? With plus 20% interest on cards. But if they're going in and buying, so if you listen to Walmart, for example, what they would tell you is that the consumer has really focused on things that are necessary, right, to live every day. So food and toothpaste and that sort of thing. And there too, they've shied away from other purchases. But there's Home Depot, Lowe's, the auto companies, anybody or any business that would necessitate long-term borrowing, probably under a little bit of pressure. The autos would fall into that category. That's a little bit mixed because they've been, I don't want to say mandated, but driven by policy to maybe increase the production of EVs, right? So if you take Ford, for example, what they talked about in their fourth quarter is demand is sluggish. We've heard that from Volkswagen. We've heard that from Mercedes. We've heard that from BMW, and most of the major auto companies. So that's a little bit different, but it's pretty mixed, right? It's pretty mixed, and I think one of the things that we'll be watching on a go-forward basis is monetary policy and what the Fed does here with rates. Instead of cutting rates, that doesn't mean, by the way, that long rates come down. Actually, when they're cutting rates in an economic expansion, that's where we are today, rates don't go down. They generally go up, which is what's happened. So we'll watch here as we move through the back half of this year and into 2025 and see if any of that changes.
Yeah, and you did mention the driver in tech in the Mag 7, and the one result we still haven't got yet, and we're waiting next week, is NVIDIA. What are your expectations for NVIDIA's earnings, and how important are their earnings for the overall market?
Yeah, well, for the last 2 years, it's been probably the most important report all earnings season. And as NVIDIA has gone, generally so is the tape. Look, it's an important company. You're talking about a company that is in a dominant position with a huge moat when it comes to generative AI and providing the processors to facilitate large language models and And then, of course, the next step of that is for companies to deploy AI and realize some sort of efficiency and enhancement to profitability. But look, I mean, I've been at it for a long time, especially as a growth manager, and I've never seen a company grow year on year on year like NVIDIA has grown. It's certainly not to the extent in the order of magnitude that NVIDIA has. And it's not just revenue growth or reported earnings. I think to me, one of the most staggering parts of NVIDIA's success has been the growth in free cash flow, which is a true mark of a high quality company and a company that's, whether the product or a service company, that's something very, very special with huge profit margins. So it will be important to see what they say. We've already heard from the big hyperscalers, Amazon, Google, Meta, etc., and they've talked about their spend on, their forward spend and their capex on AI-related initiatives, which points right to NVIDIA. And I would say that was very bullish in Q3, maybe with the exception of Meta, but Google was constructive. Amazon was probably the best of the bunch. My guess is, NVIDIA will be positive.
No, that's some really great analysis on NVIDIA. I know a lot of our users are very interested in it. I mean, where do you see the kind of this cap in the possible growth? And you said that's, it's really been quite astounding for this to happen. And just curious to say, is there some type of limit? They already have a significant portion of the existing market, but that market is just growing at leaps and bounds.
Right, that's right. So their share take has been massive, right? And they have competitors, and more competitors will come online. Some of them perhaps are private companies, but when you think about the public companies that may compete there to an extent, AMD, Broadcom come to mind. But yeah, NVIDIA has been the dominator. I think you do run into the law of large numbers, right? So the investing business, stock market business, is really a rate of change game, meaning you want, if you're a growth manager anyway, you want to be looking at companies that are growing revenues at a strong double-digit clip and growing earnings at the same pace. At some point, when you've gone through such exponential growth, the comparisons get very, very difficult. So, for example, NVIDIA's earnings were up plus 500, I think, last year. They'll be up another 100% this year. But the rate of change and the law of large numbers will start to catch up. Doesn't mean that's a problem, right? They're still the category killer, but the rate of change will slow a little bit just because it has to, right? Doesn't have to, I guess, but it probably will.
Yes, I totally get it. Thanks so much for that analysis. And I know what's on the mind of a lot of our viewers is the election and the results of that election. We saw the market, rip up pretty quickly in the first few days after the elections. It's come off a little bit, off about 1.5% today on the S&P 500, but still significantly higher than it was before the election. And so wanted to get your take on the possible impact on corporate earnings of the election results going forward this year and into 2025.
Okay, so a couple things with that. Believe it or not, the stock market doesn't care about politics, and it doesn't care about elections. So that's the first thing, and that's true over long periods of time. So if you look back over 100 years, what you'd see is the movement in S&P 500 earnings is going to be up and to the right, and the S&P 500 price is also up and to the right with a correlation of around 0.9. There is a difference, a slight difference anyway, depending on what the composition of government looks like, right? So if you look back over the course of 100 years and you say, all right, we've got a Republican sweep, generally, how does the S&P perform under that composition? What does earnings growth look like? That is the most bullish scenario, where S&P annualized returns under that backdrop, somewhere around 14%, earnings growth somewhere around 15%. But actually, if you look across any configuration of government, president and Congress, going back 100 years, what you will see is that equity returns are positive under all configurations. That's the first thing. And you don't see a lot of dispersion around earnings growth either. Now, yes, there are minor tweaks, like the Republican sweep is the strongest, but for the most part, earnings grow regardless of leadership. And I think the performance here, the stock market probably started to sniff out a Trump win sometime in October. But probably the most important thing to discuss here, in addition to the election, which I'll get to in a minute, is where we are in the economic cycle and what's happening with Fed policy, and together what those two things mean. And then you throw a Trump and Republican sweep on top of that. So we're in a pretty rare scenario here where the economy has cooled a little bit from last year, but it's still growing, right? So we're in an environment where the economy is expanding. And on top of that, the Fed has already started to cut rates, right? September 18th was the first cut, 50 basis points. We've got another one here recently, 25 basis points, and they might continue, or they might pull the throttles back a little bit. But that combination of cutting rates in a period where the economy is expanding is exceedingly rare. That's happened 4 or 5 times in the last 50 years. I've managed through that as a PM in the 90s. We saw a couple of those. That really is what's got the animal spirits alive here. And then on top of that, you have the results of the election, right? And so if you think about what Trump has championed in the campaign, and oh, by the way, we've already seen 4 years of this in real time, potentially, right, lower corporate tax rates, the extension of the Tax Cuts and Jobs Act for individuals could mean potentially better earnings. Deregulation could mean potentially an uptick in M&A. All of that is constructive, I think, for risk assets on a go-forward basis. And if you look historically at when the Fed is cutting rates in an economic expansion, that's where we are right now. I just said it's reasonably rare, but here's some interesting stats. So historically, when they're cutting rates in an expansion, from the point of the first rate cut out a year, average S&P returns, believe it or not, are plus about 17%. That's the first thing, right? The second thing is when they cut rates and the S&P is at an all-time high, which is right where it was in September. It was at an all-time high last week when they cut. That too is very rare. It's occurred maybe a dozen times in the last 50 years. You look at that analysis, first cut with the S&P at an all-time high, forward returns for the S&P average about 18% with a 100% hit rate. I don't think we're going to see that next year, right? Because the starting multiple today is 22. In the other periods, it was somewhere around 17. So the stock market's expensive. The stock market's already discounted some of that. And by the way, from the first rate cut, the S&P through yesterday was up about 7%. Now it's off about 2.5% from its high. It's down today. So some of this, what we've seen here in stock prices, and remember, the stock market discounts, it looks forward, right? It immediately reacts to all available information. Everything that's known and knowable is reflected very quickly. Some of the expected result of a Trump win and a Republican sweep is being discounted here. I think on a go-forward basis still looks constructive, but I wouldn't expect strong double-digit returns for next year necessarily, even though that's what history indicates, just because the starting multiple is high. But Trump is viewed, and we're going to see this when we hear from management teams, right? When he won in 2016, the change in tone. So Justin, if you were the CEO of a company and I was the CFO of the company and we're on an earnings call together, what we heard in 2016 was a 180-degree change in tone from you and I, right? Where before we felt like we were too regulated and our corporate tax rate, marginal rate, and statutory rate was up and it was, potentially putting downward pressure on profitability. Trump does the 180 with that, right? Lower cuts, deregulation. That probably will spur management teams to use some cash if they have it. It could be investing in their own business. It could be acquiring a competitor. It could be a whole host of things. But I would expect that as we get to Q1, calendar year Q1 next year, we'll start to hear some of that in earnings calls. That's my guess.
Great. And the other thing I'm getting a lot that our users are very interested in asking about is, a lot of this does seem relatively positive for earnings, but they want to know the impact of possible tariffs might have on different sectors, on different companies. How much, even if this hurts European or Asian markets, does that bleed through to the U.S. or is the U.S. on its own island? Can you give us some thoughts around possible tariffs and the impacts?
Yeah, so look, we've seen this already. We saw tariffs put in place in Trump 1.0. And that didn't seem to cause any inflation. Core inflation in the 4 years he was president was just under just under 2% or thereabout. Biden administration kept all the tariffs, right, that Trump had put in place. I don't think that was the source of inflation. I think COVID was, and the impacts on supply chains, the U.S. consumer demand for durable goods, or redoing, like so we talked about Home Depot earlier, renovating your house while we're all at home. To a lot of people chasing too few goods caused price pressure, right? That's economics 101, and that was really the source of inflation, in addition to the fiscal response to COVID. And so that's starting to wane a little bit. I think the jury's a little bit out here because of what Trump has said in terms of huge numbers of tariffs. If I were to guess, and just listening to him and watching him operate, I think his negotiating tactic really is, let me punch you in the face first. We'll start the negotiation there, meaning let me threaten you with sky high tariffs, and then we'll end up someplace below that. So there is concern about it. And ultimately, it will depend on how a company handles it. So if you and I are running a business here in the United States and we're sourcing all of our widgets from China and we get whacked with a 20% tariff, you and I have a decision to make. Do we eat those costs? Do we pass those on to our customers? If we're going to pass those on, then that is inflationary. If that is widespread, then you can argue for an uptick in inflation. If you and I can offset those input costs, we can reduce SG&A. There's other things that we can do to absorb them, and we don't pass them on, then that's not inflationary. So I think a lot of it's going to come down to how individual companies and industries handle it. And honestly, we don't really know yet. But one of the things that we have seen in other markets that I think we're responding to a potential Trump win and maybe even a Republican sweep started to show themselves in the middle part of October. So what do I mean by that? We saw an uptick. We saw strength in the U.S. dollar. We saw 10-year bond yields go from 360 to where they are today. It's about 445. We saw Bitcoin rip. We saw equities be reasonably firm. We saw inflation expectations vis-a-vis 1-year break-evens, 2-year break-evens, 5-year break-evens all start to move up pretty substantially. I think those are a combination of underlying economic strength in the United States, but also some speculation and perhaps readjustment or recalibration to Trump potentially winning. And then he goes ahead and he does win, and none of that has really changed. So, I don't think we have the answers to it yet, but we're going to find out as we go forward here.
All right, great answer. Really appreciate that. There's a lot of ways to categorize these stocks. Many of our viewers are familiar with sectors like tech or financials, but stocks can also be categorized based on growth and value. How do you know if a security is a growth stock or a value stock?
Yeah, great question. So I'll give you the traditional metrics, and then we can talk about at the margin how it can be interpreted and implied or used differently. So I would say the traditional metrics for a growth stock would be as follows. So a company that is rapidly growing their earnings. Now, in the early stages, the company might not make any money. It might be, right? Think back to 2000, for example. That was the case. Best case is the company's making money, but that they have some sort of definable and large TAM, total addressable market. And so there's a long runway for growth. NVIDIA is the perfect example of this, right? Where they're working on supporting and allowing for widespread adoption of artificial intelligence and other things, right? So their products are in massive demand. They're the category killer. There's a huge moat around their business. As a result, they have substantial pricing power. They also have the best product. That results in the best, super high gross margins and super high operating margins, very high net income, and high earnings growth. And so when you get a strong revenue grower, and additionally, in the case of NVIDIA, which can be exceeding the rate where their free cash flow is explosive and their earnings are also explosive, that is a very good example, perhaps the best example of a traditional growth company. The other way you can think of it are high quality companies that go through growth phases with very good management teams that are very skilled at deploying capital, whether to internal projects that are already underway or greenfield projects that they want to that are just starting, and their return on invested capital continues to compound over time. We call those companies long-term structural compounders. People on Apple would be a great example of that, right? And there's plenty of other examples away from tech. That's generally how you think about growth companies, right? So long runway, revenues that are ramping, that should lead to significant profitability. And usually what comes along with a company that has that profile is a PE multiple that's really high. That's probably way in excess of its peers, in excess of the overall market. And that's the stock market telling you that substantial earnings growth is probably coming down the road, right? And so those companies think Amazon is a good example of that. That has always been, if you just looked at it on a valuation basis, you'd say, I'm never going to buy that stock. But in reality, from the time they came public, you probably should have, right? And the multiple's been high the entire way. So that's another thing that comes along traditionally with growth companies. But you can have there's some nuances here too. You could take it down a notch from all gas, no brake growth companies to companies that have growth, but at a reasonable price, which means they have some sort of, perhaps double-digit earnings growth, but the multiple's not 60. The multiple is, 30 or it's 18 or somewhere in that range. Also a growth company, but maybe doesn't have the horsepower and the beta of something like NVIDIA or Amazon over the last, 30 years. Those are traditional growth companies. And then the final thing could be you have a company that, let's say, for example, today, might be struggling, right? And it might be classified as a value company where it's really cheap on a valuation basis, cheap price to book, cheap price to cash flow, but there's no real catalyst to cause that company to see anything substantial with regard to revenue growth or earnings growth. But there might be. And so you're doing work on a company, you're talking to the management team, and you might identify in the course of research that, hey, there is a catalyst here to take this company away from being a quote unquote value company into something that could be a lot more explosive. And that too happens with some frequency. And so there's a couple different ways to think about being a growth investor.
No, that's a great explanation. And I think a lot of people want to know, growth versus value. What is for them? How do you choose as a retail investor whether you should be mainly investing in growth or mainly investing in value?
Okay, so both have merits over time, right? And ultimately, as investors, so I was slotted into a box where I was a growth investor, right? So that was my universe. Now, for an individual investor, for an institutional investor, you don't have to be. And so you probably want exposure to both, and both can serve different purposes. So it's really up to the investor as to what their time frame is and what their risk tolerance is, right? I mean, I think that's super important. But maybe we should talk about what a value company is and compare and contrast that with what a growth company is. So a lot of times people will say to me, I think the economy is going to slow down or the market's made a big move here. I'm going to invest in value companies because they want protection. That's completely incorrect. What they want to say is, I think the stock market's overpriced and I think there's downside risk for whatever reason. And I think the economy might be in trouble. They don't really want to own value companies. What they want to own are defensive companies. Those are mostly consumer staples, right? So think about things that we need to run our lives: toothpaste, food, toilet paper, etc. Right? That's not a value company. Value companies actually are very sensitive to the economy. So think banks, think anything that's industrial, think anything that's metals, mining, and materials, think retail, right? Those are super sensitive to the economy, and they are far from defensive. So value really equates to cyclicality and high beta to the economy. And so when value really shines, right? So growth companies do very well when the economy is not really driving their business, right? So if you think about Apple, NVIDIA, the classic growth names that everybody knows, those businesses are really semi-impervious to GDP. They're not completely immune from it, but they're a lot more immune from it than a retailer is, or a copper company, or a mining company, or a heavy equipment company, right? So they can persist and perform when the economy slows down because their earnings don't really get knocked around. That's very different for a quote-unquote value company, which are generally cyclically oriented, right? So if you take Caterpillar, right? Everybody knows what Caterpillar does, mining equipment, construction equipment. Their business is very, very impacted and driven by the economy, not just in the United States, but globally. So as the economy slows, demand to build new buildings or roads or build a new mine or buy new equipment to run the mine or extract the materials will slow, right? As a result, their earnings can collapse. So they're very sensitive to the economy. When you're heading to recession or in a GDP slowdown, those names do not work. When you're coming out of recession, that is the single best time for value companies. And that is really, it might not be the only time, but it is, exiting recession is really the time where value companies generate substantial alpha relative to growth companies. I'll give you the most recent example of that. We go through COVID, right? And the economy, the Fed takes interest rates to zero, short rates, and then long rates, go to 1% on 10 years. And why are they doing that, right? They're doing that to stimulate demand and risk taking. The economy starts to exit. We get Pfizer and other vaccinations for COVID in the fall, and GDP starts to improve. The lead horses out of that were all the cyclical or value names, right? It's textbook. That's exactly how it works. That works every time in history. So exiting recession, even better if it's a global recession, that's where value really works. And growth has different dynamics. So I think the point there is you should have exposure to both. Probably not try and time it unless you feel like you've got some edge and you really know what you're doing. But there's a place for both in portfolios.
No, that's a really great answer. And I think we have one user kind of asking about that in terms of, you talked a little bit about the cycles and what they want to know what specific indicators investors might watch for in earnings reports that may shift the signal in market sentiment towards growth or value, or is this only more economic data that you should be looking at?
So look, it can be both, Justin. So there's all kinds of high frequency economic data points that you can use to try and ascertain where you are in the business cycle or the economic cycle. So I'll give you a couple, but the yield curve, the difference between two-year note yields and 10-year note yields. People watch this carefully. We watch it too. An inversion of that relationship, meaning the Fed is probably raising rates, putting two-year yields up. Long rates are coming down. That's called the yield curve inversion. That's usually the precursor to a recession. Lead times 14 to 16 months, something like that. That didn't work this time. Actually, the yield curve was inverted for 2 years. We didn't have a recession. It doesn't work every time, but it's got a hell of a track record that generally you don't want to bet against it. You can look at the Institute for Supply Management publishes a lot of economic data with regard to the service part of the economy and the manufacturing part of the economy. There are levels in the PMI data set that can let you know whether you're close to recession or going into recession, and conversely, levels that are associated with the depths of recession, and that therefore the next 6 to 12 months you ought to be exiting recession. You should know how to use those tools and know what works. And of course, there are comments from company managements that will give you inflection points. So if you've been following a company for a couple of years or maybe a couple of quarters, I don't know, and you're in tune to what their message is, and they're giving forward guidance and commenting about the status of their business, you can pick up when they start to, certainly if they lower guidance and say, hey, demand for our products is being impacted by ABC, and we expect earnings to be down. Okay, that's probably a bad sign for the company and probably a bad sign for companies that are in similar businesses and maybe in other industries too. So there's a couple different ways you can look at it, company specific. So that'd be like the micro, through the micro lens, and then the high frequency economic data, i.e. the macro lens.
So that's some really great analysis of growth versus value. Now I'm going to get into a few of our user questions. A lot of our user questions have been asking about possible recession, and before you mentioned defensive stocks, which you said were much different from growth and or value. And so I want to ask you kind of the strategies you might use if there are a recession, or what type of defensive portfolio combination might work, or how you can insulate yourself from market volatility.
Okay. Here are the statistics for the equity market around recession. So bear markets associated with recessions, here's generally what happens. First of all, and most importantly, the max drawdown, meaning the biggest point of pain, peak to trough in the S&P historically, when you're in a bear market associated with recession, is about 30%. I think it might be 31.5. So that's the first thing. Second thing that happens is at the index level, earnings degrade. So at the S&P 500 level in a recession, normally at the median, you'll see earnings degrade by about 15%. That's the reason stock prices are moving down. And you also see a compression in the PE multiples somewhere around 20%. All that in the stew creates a bad environment. That is exactly what we saw lock, stock, and barrel in 2022, right? All of those boxes could be checked. So what do you do in that scenario? So you're heading into recession. Your dashboard tells you we're likely to go into recession. So best case is you sidestep equities because nothing's going to work. Growth is going to hold up better than value, but at some point, probably all going to be negative, right? Cash is one. Long duration is number two. So own U.S. Treasuries or corporate bonds or muni bonds with intermediate to longer duration. Cash and the combination of that will protect you. Nothing else will.
Great tips for all of our retail investors here. And in terms of advice or tips you can give to someone that's new to investing, a beginner, just still learning to trade, what advice where should they be focused?
Okay, so you can think about this if you want to learn how to play golf or you want to learn how to ski. All right, so we need to take lessons, right? You need to do some research and prepare yourself. So I don't know how many books I've read in my career. It's probably over 100 on investing, on different methods you can employ to trade, and the risk controls that you need around trading and to stay alive. So I would do that. There are great books out there. I'll give you a couple, but one time-tested classic would be Reminiscence of a Stock Operator about Jesse Livermore. How I Made $2 Million in the Stock Market is another. One Up on Wall Street by Peter Lynch. Being Right or Making Money by William O'Neill. Like there's many more. I would read those, and then I would trade on paper before I exposed any capital. And the most important thing, the most critical thing for me as a portfolio manager, or for anybody listening that wants to sit at home and try and trade stocks and make money, do not let your losses get out of control. Understand and learn how to use a stop loss order and make it good until you cancel it. Meaning you buy a stock and you automatically set a predetermined exit point and you quantify what your loss is before you even get into the trade. Understand the risk reward, but above all else, risk control is the most important. And if you make a couple mistakes, and you will, and I've made them all, if you get knocked out and you get your capital cut in half, you buy a stock, you lose 50%, you sell it. Now you need to make 100% to get your capital back to where it was. So controlling losses is by far and away the most important thing.
All really great points. And here at Moomoo, it's really nice. We do have a paper trading option for our users that they can use. And when you're just starting out, it's a really a great place to start, because you can take those books and educational materials and read them. And then you can also practice without putting your real money at risk. And it's something, to me, it was not available for a lot of people in the past. And now this is something that is available. You don't have to have your money at risk right away. You can kind of wait till you're comfortable before you start making those real money investments. And I know a lot of our users are also asking me a lot of questions around valuations and in bubbles. And so where are stock market valuations relative to history? Is the market in a bubble, or are there specific sectors that might be in a bubble?
Yeah, common question. So right now, the S&P 500 is trading at 22 times next year's earnings. And so to frame that, the long-term median forward multiple is 16.8. Let's call it 17. So the take right now is 5 turns rich relative to history. Do I think that's a bubble? No. I ran money through 2000, and that was a bubble. So let's compare. I must say that also bubbles are only really known with the benefit of hindsight, right? But in 2000, it was, you had the stock market was straight up, NASDAQ especially straight up. At that point, the S&P was north of 30 times earnings. Today's 22. You had the poster child stocks at that time. Let's use Cisco Systems, was probably 100 times earnings, right? Compare that to maybe NVIDIA today, 38, 40 times earnings. Don't quote me on that because it moves around. The fundamentals today and the big names that people want to talk about, and I think NVIDIA is a good one, the fundamentals are vastly, not a little, not a lot, vastly better than they ever were in 2000. And so, I don't think right now we should be worried about a bubble. per se. The fundamentals are just great. Now you do have the element though of some of these names like Nvidia, where the stock price is straight up, right? So if you bought that stock on a split adjusted basis in March of 2020, right in the peak of COVID, you could have bought Nvidia for $5 as an example. Now it's whatever 150 plus. That's a huge move. So it comes back to controlling risk. But no, I don't think we're in a bubble. The tape is not cheap. Make no mistake about it, right? The market's expensive.
No, that's a very good point for people to understand. There's definitely a difference between having a bubble and just having a market that is above average in terms of its valuation. Doesn't necessarily signal bubble. Well, I want to thank you so much for being with us here today and offering our viewers so many great insights. Any last thoughts for our audience?
I think when it comes to trying to navigate equities and manage your own money, do your homework, right? Do your research. I would be very careful about listening to anybody you see on TV, and remember that what they're talking about is they're espousing their own book and the way they're positioned, right? So if they're bullish on a name, they probably own it. Do your own work. And all the information is publicly available. You go to a company's website, go to the investor relations tab, get the 10K, put it in Excel, start to try and improve your modeling skills. Look, I think the most important thing is there's a couple. If you're investing for long periods of time, investing in the stock market on a dollar cost average basis is the way to go. That's factual, that's proven. If you want to, that's a long-term investor. If you want to try and trade, position trade, swing trade, whatever you want to do, that's fine. By far and away, the most important advice I can give you is make sure you find a mechanism to control your losses.
Great advice. Thank you so much. I want to thank everyone else for tuning in as well. Make sure to check out the special offers on our website if you're not already a Moomoo user. We'll be back in about 10 minutes with our next webinar, Insights on How Moomoo Users Are Trading Options, with guest Vince Chico, Director of Derivative Sales for U.S. members at SIBO Global Markets. Until then, stay tuned for a short video.
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
He's talking about investing. Do you invest too?
Moo.
There's so much research to do, but so little time. But how do I actually start?
Download Moomoo! Investing made easier. Download Moomoo now.
Moomoo has partnered with derivatives world leader Cboe, bringing you an options experience like never before. 5 major index options are now available to trade on Moomoo. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Moomoo's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Moomoo now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed round-the-clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home dance to someone else's tune? Or Moomoo your own?